Montek Singh Ahluwalia, Deputy Chairman of the Planning Commission, into this discussion. Mr. Ahluwalia, good morning. Do you agree with the Secretary Economic Affairs that the rupee has fallen because of a speculative attack, or do you think this fall is tying in with the weakness in other emerging market currencies, markets which are running, or economies which are running large current account deficits? So there is a grain of consistency to it.
Well, I think the Finance Ministry has actually said in another context that if you look at it globally, it's not just the Indian currency that has fallen. Quite a lot of emerging market countries, actually most of them that had current account deficits, have seen a depreciation. Some more than us, like South Africa, some roughly comparable, like Brazil or Turkey. So I think there is a global phenomenon here. Currencies have been volatile, and the whole focus of the exchange rate between the rupee and the dollar tends to exacerbate this, because actually the dollar has been appreciating a little bit, possibly because of inflows into the US in anticipation of the fact that the reversal of the QE2 might take place, QE3 might take place, which would tend to increase bond yields, which would actually increase bond prices. So you would expect that people would move into US financial assets, and that would strengthen the dollar against many other currencies. So I think that's a relevant factor. As far as the Indian economy is concerned, we're not at the moment at our strongest. There's no question about that. We do have a current account deficit, which is, by our own statements, too large. And we are taking steps, macroeconomic steps, to bring that under control. Now, in that environment, when you have global volatility, you can see the currency move around. What you call speculation and what you call market operation, always very difficult to distinguish. So I personally think that what you're seeing is a bouncing around of the currency. I don't believe that the description free fall, which many people have used, particularly in our media, is at all justified. Yes, you're seeing a slightly sharper depreciation than you would expect, and I think the Finance Ministry feels that this will correct itself. It certainly won't continue. But that is ultimately something that will be determined by short-term market pressures. We can't predict it. The important thing to remember is that, we're not defending any particular rate, but at the same time, the RBI intervenes when it thinks things are getting pushed a little too far. Now, they did intervene yesterday, which would suggest that they felt that market pressures were pushing the currency to an unnecessarily low point, and that did lead to some reaction. I don't think that one can say anything more than that when you're dealing with an exchange rate that's market determined.
At the same time, there has been talk yesterday, Mr. Ahluwalia, of an NRI bond issuance, etc., which means that it's not exactly that the government is watching from the sidelines and is not intent to, or not worried about the way the rupee has come off, because otherwise why would they talk about an NRI bond issuance at this point?
No, let's be very clear about it. The government is certainly not waiting in the sidelines and simply expecting things to correct themselves. The important thing to look at is not whether we issue a bond or not. Those discussions are always on. I have no detailed information on what exactly is being considered. But the government has said that, number one, we must address the current account deficit. So government policy has to be judged by our own statement that we do not think that last year's current account deficit is sustainable, and we've taken a number of steps to bring it down. So it's not just a question of financing. We're not expecting to finance a 5% GDP current account deficit. We expect it to be significantly lower. And I think markets should look at what is it that we are doing to bring that about. Now, we're doing quite a lot. Number one, the fiscal deficit's been brought more effectively under control last year than was even targeted, and a further reduction is expected this year, which I'm sure will be achieved. Number two, investor confidence. I'm not referring now to bond issues, but confidence on the part of FDI investors. Number of steps have been taken primarily to correct some of the real supply constraints affecting the economy, and these decisions, particularly on coal supply, etc., are currently in the works, and I expect to see a resolution of that very, very shortly. That's very important in giving investors the confidence that the investments that have been made in power generation are not going to be ignored in terms of their fuel supply agreements. Number of other steps are being taken which relate to policy on foreign direct investment. There's a committee that's looking at what our FDI rules are and how they can be simplified. So I call all these as substantive steps designed to restore investor confidence and also to reduce the current account deficit. Now, within that, yes, we can look at other instruments of financing, and certainly bonds of the kind that have been talked about are one of them. But I don't think that's going to be a very large part for the solution. It's the totality of our effort to convey the impression that the current account deficit is being brought under control and that the economy is going to rebound. I think that's what we should really concentrate on. You know, right now, I think there's evidence that it's sort of bottomed out, but not enough evidence to suggest how strongly it's going to rebound. Now, I believe we have an opportunity in the current year to go back to something like 6% growth from the 5% that was achieved last year. I mean, ideally we should even go above 6%, but it's very difficult to predict what will happen. But that's really what we're talking about. Once investors see that the Indian economy is back on a higher growth path, then I think financing the deficit through normal flows will not be all that difficult.
Let me talk about this financing issue, Mr. Ahluwalia, because that's very, very germane to what's going on across global markets today. US bond deals, as you would well know, have started hardening, and that's putting a lot of pressure on emerging market currencies. FIs have sold quite a bit of Indian debt also in the last fortnight, as you would know. But do you think financing the current account deficit might become a challenge if this kind of a global mood were to prevail?
Oh, certainly. I think financing the current account deficit was always known to be a challenge. In fact, in virtually every single official statement, ranging from the 12th plan documents to what the finance minister said, what the prime minister said, we have said this is a major challenge. And that's why I think to address that challenge, I don't think you talk about one instrument or one initiative. If you want to finance a current account deficit of this size, the government has to have a full deployment of policy which will reassure people that the Indian growth story is back. India welcomes foreign investment. We address the concerns that foreign investors have, and we remove supply constraints which are holding back if you like, the fulfillment of a lot of investments that have just matured, particularly in the power sector. Now, I think we need to display, and which we can do, maybe in the next few weeks even, we need to display a series of positive steps which are being considered, and therefore I think it's quite possible that we will be able to put across a very positive picture.
Your